Fundamental analysis. Sounds complicated? Don't worry, it's simpler than you think. In essence, it's about looking under the hood of a company before you invest. Imagine buying a car. You wouldn't just look at the paint job, would you? You'd check the engine, mileage, and overall condition. Fundamental analysis is similar. It involves examining a company's financial health, its management team, its competitive landscape, and its future prospects. We want to understand the engine that drives a company's stock price. We're not just chasing short-term gains. We're looking for long-term value. Think of it as detective work for investors. We're gathering clues, analyzing evidence, and forming a conclusion about a company's true worth. By understanding the fundamentals, we can make more informed investment decisions. Ready to become a stock market detective? Let's dive in. Why go through all this trouble? Why not just buy stocks that are going up? Here's the thing, stock prices can be misleading. Sometimes a stock might be hyped up without a solid foundation. That's where fundamental analysis comes in. It helps us cut through the noise and focus on what truly matters. A company's intrinsic value. Are they making money? Are their sales growing? Do they have a solid plan for the future? These are the questions that fundamental analysis helps us answer. By understanding a company's financial health, we can make smarter investment decisions. We can avoid companies that are overvalued and identify hidden gems that the market might be overlooking. Remember, investing is a marathon, not a sprint. Fundamental analysis helps us choose companies that are built to last. Now let's talk numbers. 3 key financial metrics form the bedrock of fundamental analysis: earnings, revenue, and profit margins. Think of them as the vital signs of a company. Revenue is the total amount of money a company brings in from its operations. It's like the company's total sales. Earnings, also known as net income, represent the profit a company makes after deducting all its expenses from its revenue. It's the actual money the company keeps after paying its bills. Profit margin is a measure of a company's profitability. It tells us how much profit a company makes for every dollar of revenue it generates. Higher profit margins generally indicate a more efficient and profitable business. By analyzing these metrics, we gain valuable insights into a company's financial performance. Where do we find all this crucial information? In a company's financial statements. These statements are like a company's report card, providing a detailed snapshot of its financial health. The 3 most important financial statements are the income statement, the balance sheet, and the cash flow statement. The income statement shows a company's revenues and expenses over a period of time, revealing its profitability. The balance sheet is a snapshot of a company's assets, liabilities, and equity at a specific point in time, providing insights into its financial position. The cash flow statement tracks the movement of cash both into and out of a company, showcasing its ability to generate cash and meet its financial obligations. Learning to read and interpret these statements is like learning a new language, the language of business. Section 5, Apple and Amazon. Real-world examples of fundamental analysis. Let's bring this to life with some familiar examples. Apple and Amazon. Apple, known for its iPhones and MacBooks, consistently reports strong earnings and revenue growth. Their high profit margins reflect their premium brand and efficient operations. Amazon, the e-commerce giant, has been investing heavily in new areas like cloud computing and online advertising. While their profit margins might be lower than Apple's due to these investments, their revenue growth has been phenomenal. By analyzing their financial statements, we see that both companies are financially healthy, but they have different strategies. Apple focuses on high-margin products, while Amazon prioritizes rapid revenue growth and market share expansion. Fundamental analysis helps us understand these nuances. Section 6. Beyond the numbers, qualitative factors in fundamental analysis. Numbers tell a story, but they don't tell the whole story. Fundamental analysis also involves considering qualitative factors, aspects that are harder to quantify, but equally important. The quality of a company's management team is crucial. Are they experienced? Do they have a clear vision? We also look at the competitive landscape. Does the company have a competitive advantage? How strong are its competitors? What are the industry trends? Understanding these factors provides a more holistic view of a company's prospects. For example, a company with a revolutionary product might initially have low earnings but massive potential. Fundamental analysis helps us see beyond the current numbers and assess the long-term possibilities. Section 7. The power of ratios. Using financial ratios effectively. Financial ratios are powerful tools that help us analyze a company's performance more effectively. They provide standardized metrics that allow us to compare companies within the same industry or across different industries. Some commonly used ratios include the price-to-earnings ratio, the debt-to-equity ratio, and the return on equity. The price-to-earnings ratio tells us how much investors are willing to pay for each dollar of a company's earnings. The debt-to-equity ratio measures a company's financial leverage. The return on equity indicates how efficiently a company is using its equity to generate profits. By analyzing these ratios, we can gauge a company's valuation, financial risk, and profitability compared to its peers. Section 8. Fundamental analysis versus technical analysis, a comparative overview. Fundamental analysis and technical analysis are two distinct approaches to investing. While fundamental analysis focuses on a company's intrinsic value, technical analysis examines historical price patterns and trading volume to predict future price movements. Technical analysts use charts and indicators to identify trends and patterns, while fundamental analysts rely on financial statements and company-specific information. Both approaches have their strengths and weaknesses, and many investors use a combination of both. Fundamental analysis provides a solid foundation for long-term investing, while technical analysis can be helpful for short-term trading decisions. Section 9. Making informed decisions. The enduring value of fundamental analysis. In the ever-changing world of the stock market, fundamental analysis remains a timeless and invaluable tool for investors. It empowers us to make informed decisions based on a deep understanding of a company's financial health, management quality, competitive positioning, and future prospects. By learning the fundamentals, we can navigate the complexities of the market with greater confidence. Remember, successful investing is not about chasing quick profits. It's about finding companies with solid fundamentals that can stand the test of time. So, embrace the power of fundamental analysis and embark on your journey to becoming a savvy and successful investor.